Okay, the show is on the road. We are ready to rock and roll. Well, I want to welcome everyone. The webinar today is to how to get the most out of your Social Security benefits. With that in mind, if you have a question, we welcome and encourage any questions that you might have. And at the bottom of your screen, you'll see a Q&A box. And if you could type in your question, we're going to do our very best to get to everyone's question at the end of the presentation. We are recording this program today, and we will be sending out the replay of all the slides and the audio about a week from now, and you should see that in your email. Important disclosure information, and this is our advisory team, myself, Sam, who is on the webinar as well, and Adam Dechtman, who's also on the webinar. And I'm proud to say that we are a family business. I founded the firm 40 years ago. We have an amazing staff of 8 folks, and we are privileged to be able to serve you. So let's go over the agenda here. And there's a lot of information. Presentation is about 45, 50 minutes. And again, we'll have room at the end for Q&A. You definitely want to stay to the very end because we have a really great offer that I think you'll really appreciate. The first item is, will Social Security be there for you? All right, we'll address that. Then we get into the basics of Social Security 101. When should you apply? What are the best strategies to maximize your benefit? And is there enough by way of Social Security for your retirement? So without further ado, I'm going to turn this over to Sam, and then I'll join back in at the end of our discussion.
Thank you for that introduction. And before we jump into today's presentation, wanted to go over a few ground rules, if you were, or things that you need to know about Social Security. One is that you have many claiming options, and the decisions that you make have far-reaching consequences, not only for the rest of your life, but also for the rest of your spouse's life while you're both living. And should you be the first one to pass, what your spouse would be able to collect as a survivor benefit. Third, sort of dovetails into the second one, the choices that you make and the choice your spouse makes impacts the both of you. Now, the system is not bankrupt, and we're going to go over this here shortly. And last but not least, your friends and coworkers are not experts. Even though they may have filed for benefits, they may have read something somewhere, that does not mean that they know all of the ins and outs of Social Security. And more importantly, when it comes to your situation, they probably do not know what is best for you. They're maybe sharing what worked for them or what they think was the best strategy for them. But unless they have the software and the knowledge and are keeping on top of it, but like us, you can take the advice that's given to you with a grain of salt. So now let's start the presentation by discussing, will Social Security be there for me, before we spend a lot of time talking about what Social Security is and how we maximize it. Social Security was designed as a pay-as-you-go system, and payroll taxes from current workers go into a trust fund and are immediately paid out to current retirees. Because baby boomers have been in their peak earning years, the trust fund has accumulated more than needed for current benefits. Right now, the trust fund holds about $2.8 trillion, which is invested in special issue Treasury securities. As baby boomers start retiring, these trust fund assets will gradually be drawn down. And we can look here at the top of the screen and see what the trust fund balance was at the end of 2021. And we can look and see what it was at the end of 2022. And we can see that the amount has started to go down. Now what we're looking at on the screen was produced from the 2023 Social Security Trustee Report, and I'll show you exactly what we're looking at. So let's first talk about this red line. This red line shows the non-interest income that Social Security is pulling in. This blue line shows the cost for scheduled benefits as well as payable benefits. Now you're going to notice that the costs are more than the money that Social Security is bringing in. That is why it's expected that if there are no changes made to the Social Security system, it will be able to pay benefits at 100% until the end of 2033. And if no changes are made, the Social Security trustees believe that there will have to be a cut of 20% of all currently payable benefits as well as future benefits. Said another way, if you are currently receiving benefits, you would get 80% of what you are currently receiving. Now, that is if absolutely no changes are made whatsoever to the system, and wanted to show you what it looks like. And so we've seen this in the past where it's been drawn out to the last minute, and we're hopeful that the folks in Washington do not kick this can all the way down the road until the end of 2033. But let's talk now about strategies about how Social Security can become more solvent. One is increasing the maximum earnings subject to Social Security tax. So not all of your earnings are taxable and put into the Social Security program. The ceiling for 2023 is $160,200. So one strategy could be increasing that and going higher and higher and using those extra funds to help pay benefits for more baby boomers that are retiring. The second strategy to make Social Security more solvent is to raise the full retirement age. We're going to spend a lot of time going over what this is in just a moment, but this is essentially an age that Social Security allows you to receive 100% of your benefit. Third is lower benefits for future retirees. While unpopular, this is probably one that will need to be taken very seriously. The fourth is going to be about reducing cost of living adjustments. And so Social Security is supposed to keep up with inflation. And COLAs are not guaranteed, but going forward, they might be reducing them even further or just not offering them at all. The last item is reduce delayed retirement credits. Social Security will incentivize you to wait to withdraw or file for your benefit, if you will. And for every year that you wait beyond your full retirement age, you are guaranteed a positive 8% increase by the program. So what they could do is maybe instead of increasing this by 8%, maybe this is instead increased by 6% or some lesser number. But the bottom line that you need to know for most baby boomers on today's presentation is your benefits are not likely to be reduced by Social Security reform. There are roughly 70-ish million people that are receiving benefits from the Social Security program, and the vast majority of those folks vote. And I have a hunch that they are not going to be supporting any politician who is going to be making sure that the reform is about reducing their benefits. I am of the belief that reform is going to be mostly the burden of younger workers that are still paying into the system to help make it solvent. But another very important point that I want to make very clear as well is that Social Security is not as dire as you are led to believe via the newspaper, television, or other outlets. We went over 5 strategies on the previous slide, and we can really make brief tweaks to one or multiple of them, and that can really get the program back on track. And so we went over sort of a worst case scenario, if you will, if no changes are made whatsoever to the program, that you would continue to receive 80%. And so again, bottom line for baby boomers, your benefits are not likely to be reduced by Social Security reform. Instead, it will be younger workers that are likely going to have to get the system back on track. All right, Now let's talk about Social Security 101 and the basics. Who is eligible for Social Security? Well, most Americans receive Social Security by working long enough to qualify for their own personal retired worker benefits at age 62 or later. However, if you are the spouse of a retired worker, you may qualify for spousal benefits now or in the future. If you are divorced, you may also qualify for benefits if the marriage lasted at least 10 years and certain other conditions are met. If you are the widow or widower of a retired worker, you're probably eligible for Social Security survivor benefits. There are several other categories of eligibility, which involve minor children or the disabled. We won't go into those matters today. If you think they may qualify, if you may qualify based on these less common factors, please contact us after the presentation so we can review your specific situation. So how are the benefits calculated? Well, to qualify for Social Security as a retired worker, you must have worked for at least 40 quarters, which is approximately 10 years. To qualify as work, you must have earned and reported that income and paid Social Security taxes on it. The size of your retirement benefit depends on how much you earned during your working life. The Social Security Administration keeps a record of how much you made every year up to the ceiling, which again for 2023 is $160,200. Any amount made over that annual ceiling doesn't get taxed by Social Security and does not figure into the formula. When it's time for you to apply for Social Security benefits, the SSA will look at your highest 35 years of earnings or substitute zeros if you didn't work for a full 35 years. They'll then apply a formula to arrive at your basic benefit, which is the sum that you'll be eligible to collect at your full retirement age. We won't go into the details of the formula, but you can find out more at ssa.gov if you're curious. Another important point to know about Social Security is that the benefit is inflation protected and one that you cannot outlive. Your benefit may increase if there is a cost of living adjustment or a COLA, as we discussed in the previous slide, but it is not guaranteed. And as long as you live, you will continue to receive Social Security benefits. Now, some of you may be surprised to learn that Social Security benefit may be taxable. Ever since 1984, Social Security benefits have been subject to some level of taxation depending on your other income. Yes, you heard that correctly. You were initially taxed on your income when you paid into Social Security, and when you receive benefits, it might also be taxed as well. The table shows the taxation of Social Security benefits based on various income levels. Now, income in this case means provisional income, and you can see the formula at the bottom of the screen, which includes adjusted gross income plus 1/2 of the Social Security benefit plus any tax-exempt interest, which is primarily municipal bond interest. If provisional income is under $32,000 for a married couple, no benefits are subject to tax. If provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. If provisional income is over $44,000, up to 85% of the benefits are subject to tax. So even if you're over that threshold, not all of your Social Security benefit is taxable, but likely 85% of it will be. And you can see the other filing statuses here, single and married filing separately in the other boxes as well. Now let's talk about when should I apply for Social Security. In order for us to understand when we should apply, we need to have a good understanding as to what ages are important when it comes to how Social Security views you. And there's 3 in particular. There's age 62. There is what is referred to as your full retirement age, and we'll also be referencing this throughout the rest of today's presentation as FRA, and then after your full retirement age. So Social Security wants to incentivize you to wait as long as possible to file for your benefit. And it will not make any sense for anyone on today's call to wait until beyond age 70 to file. So if you have not filed and you are over age 70, the time to do it is right now. But let's begin by talking about at age 62. So we just discussed that they want to incentivize you to wait. So they will give you more benefit to waiting to age 70, And on the reverse end of that coin, if you want to file early, your benefit is going to be reduced by 25 to 30%. And that will all depend on what your full retirement age is. And now that reduction is a permanent reduction and will not be increased later. Your full retirement age is what they consider to be 100% of your benefit. And for everyone on today's call, your full retirement age is somewhere between 66 and 67, depending on the year you were born. And on the next slide, we're about to go over what that looks like. And lastly, with the full retirement age, or excuse me, after full retirement age, for every year that you wait beyond your full retirement age, you are guaranteed an 8% increase in your benefit. And this is a permanent increase. So if you have not done it by age 70, recommend that you do that right away. So now let's spend a moment talking about what the full retirement age is, and we can see here on the chart what your particular full retirement age might be. So the full retirement age is the age at which you can claim full unreduced benefits. It used to be 65 for everybody, but now we're seeing a higher full retirement age being phased in as a result of the 1983 amendments. For everyone born between 1943 and 1954, the full retirement age is 66. For everyone born in 1960 or later, the full retirement age is 67. For those born in 1955 through 1959, the full retirement age is 66 plus some number of months. So you should be able to figure out what your full retirement age is. If you're still not sure, you can go to ssa.gov and they will have it calculated for you on your Social Security benefit estimate statement. This is a chart where we want to show you how much your benefit will be reduced for filing early. And we can see the ages here that we apply on the left-hand part of this chart. In the middle, this tells us if our FRA is 66, so full retirement age is 66. So we go here to the column where it says 66 and we see it says 100. So if we were to file at the earliest possible time, we would get 75% of what we would expect to receive at 66. So that is a 25% reduction. Now, if our full retirement age is 67, we can see that that reduction for filing at 60 is even more significant, where now the reduction is not just 25%, it is 30%. Now, you don't have to wait until you reach a particular birth date to file to not have the full scope of a reduction. It is prorated on a monthly basis. And so even if you can go an extra month or two, you are still going to benefit from waiting that period of time. On the other end of the coin, we look at the higher benefit for delaying. And again, you will earn an 8% annual delayed credit. So in this middle column, we can see what the benefit would look like if you waited beyond your full retirement age. So we can see that if your full retirement age is 66, if you waited until age 70, you would get 132% of what you would have been able to expect based on your, you get a 32% increase based on what was expected at your full retirement age. And if you had a full retirement age of 67, we can see that you would get a 24% bump in terms of what would be expected. Now, what does this actually look like from a dollar figure? Because percentages can be a little hard to really understand how this is going to affect you in real life. So now what we wanted to show you is what you might be able to collect on a monthly basis, depending on the age that you are on the left-hand side and when you initially started claiming. So let's look at if we claimed at 62 and we are receiving our benefit at age 90. At age 90, we might begin to collect $3,656 a month. Whereas if we look at age 90, but we had filed the claim at age 70, that'd be $6,466. Now, it is not quite double, but it is significantly larger benefit that you would begin to collect at age 90. Now, you might be at home saying, Sam, there is no way that I'm living to 90. You know, I'm not sure that that was the best example to give. And what I would respond to you is say that if you are a couple and both of you are age 65, there is research to support that one of you is likely going to make it to age 90. So whether or not you feel that you're personally going to make it, you or your spouse, if you've both reached age 65, are likely to reach that age. And so it's very important that we think about the implications of not only how much we're collecting while we're living, but what the surviving spouse might be able to collect after the first spouse has passed. Now let's go over some different rules. We spent a lot of time referring to the benefit of the worker, but now we're going to talk about spousal benefits, divorced spousal benefits, and survivor benefits. Now, the spousal benefit is the greater of these two options. You will get the greater of half of the primary worker's full retirement age amount, which is also referred to as a PIA, and the lingo Social Security uses is primary insurance amount, or the benefit earned on your own working record. So here is an example below. So in this example, John is the primary worker and Jane would be considered the spouse. So if John's PIA, or primary insurance amount, the amount he could collect at his full retirement age, is $2,000, and Jane's PIA, primary insurance amount, based on her own working record, is $800, we can see that if Jane applies at her full retirement age, her benefit would be $1,000. That is because $1,000, which is 1/2 of John's PIA, is greater than the benefit that she would have received based on her own working record. Now let's get into other rules. So if you are going to collect a spousal benefit, the primary worker must have filed for their benefits. So in the previous example, had John not filed for benefits yet and Jane had filed, she would be getting that $800 based on her own working record. Second, the spouse must be at least 62 for reduced benefits or full retirement age for full benefit. So what does this mean? If the spouse files at their full retirement age, they will get 50% of the primary worker's PIA, or primary insurance amount. In the previous example, if Jane had filed earlier, instead of getting 50% of John's, she might get 42. She might get 45. It depends on how much earlier she filed. And at age 62, that would be the most reduction that would be possible. Lastly, there are no delayed credits on spousal benefit after full retirement age. So if you are in a relationship and one spouse has been the primary worker and the spouse's benefit based on their own working record is less than half of the primary workers, it would most likely benefit both of you to have the spouse file at their full retirement age. In all likelihood, it would not make sense for them to continue to wait. Now let's talk about divorced spouse benefits. So a woman can receive Social Security based on her ex-husband's working record, providing the marriage lasted at least 10 years and she is currently unmarried, and vice versa. Men can receive divorced spouse benefits too. If the divorce occurred more than 2 years ago, the ex-spouse doesn't need to have filed for their benefit. However, the ex-spouse must be at least 62. For other rules, more than one spouse can receive benefits on the same worker's record. So if your ex-husband has remarried a couple of times, all of his 3 ex-wives can claim divorced spouse benefits as long as the marriages lasted at least 10 years. The benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or other ex-spouses. You do not need to know where your ex's whereabouts are, only enough identifying information that the Social Security people can look up his or her records. You'll also need to provide documentation showing the dates of the marriage and the divorce. If you are receiving divorced spouse benefits and you remarry, your divorce benefits will stop. However, you may then be eligible for spousal benefits based on your new husband's or new wife's work record, or you can switch to your own benefit, of course, if you qualify for Social Security based on your own working record. Now, let's talk about survivor benefits. Survivor benefits can be somewhat complicated, but it's important to understand how they work because decisions you make now can influence the amount of the survivor benefit later on. There are two factors that influence the amount of the survivor benefit. The first factor is the age at which the deceased spouse claimed their own retirement benefit. If they originally applied for Social Security before full retirement age, the survivor benefit will be limited to the deceased spouse's actual benefit or 82.5% of the PIA, which is primary insurance amount, or the amount that would have been expected at the full retirement age, whichever is higher. If the deceased applied at their full retirement age, the survivor benefit will be equal to 100% of that amount. If he or she applied at 70, the survivor benefit will include those delayed credits. So if they had applied at age 70, the survivor would get that increased amount. The second factor influencing the amount of the survivor benefit is the age at which the widow or widower claims the survivor benefit. If he or she claims it at 60 or 50 if disabled, the survivor benefit will equal 71.5% of the decedent's PIA. And I want to come back to that point. If you are a spouse and your spouse is living, the earliest age is 62. If you are a survivor, the earliest age is 60. So back to regular scheduled programming. If he or she claims it at the full retirement age or later, the survivor benefit will equal 100% of the original amount. They may, of course, apply any time between ages 60 through 70, and the reduction will be prorated. Now let's go over some rules. For the surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months, except in case of an accident. To start benefits, the survivor must be at least 60 or 50 if disabled. However, if the widow or widower applies before their full retirement age, the benefit will be reduced as it is for regular retirement benefits. If you remarry before age 60, you will not be able to receive a survivor benefit based on your previous spouse's earnings record unless your remarriage ends. The divorce, okay. So now we're moving on to strategies for widows and widowers. What if you've already been widowed? Let's say your spouse died or either before or after starting Social Security benefits. Or maybe you were married over 10 years, divorced, and your ex-spouse has died. Is there anything you can do to coordinate your survivor benefits with your own retirement benefit to maximize income and lifetime benefits? The answer is yes. You can sequence your benefits to maximum advantage. You can start with one and switch to another. So I want to say that again because this is particular for widows and widowers. You can start with one benefit and you can switch to another. The rule here is to always take the higher benefit last. If the survivor benefit is higher, start with your retirement benefit at age 62 and switch to your survivor benefit at full retirement age. If your retirement benefits are higher, start your survivor benefit as early as age 60 and switch to your retirement benefit at age 70. Now, we do want to help you run the numbers, so don't just take this and run with it. Let's run the numbers and see what makes sense for you, but by and large, that's a good principle to abide by. Now, let's talk about best strategies to maximize the benefits. Now, the factors that we're going to consider when we're advising clients on when to file, we're going to be taking into account your health status, life expectancy, need for income, whether or not you plan to work, as well as survivor needs. All of these factor into the decision. So it's not necessarily always a black and white in terms of when we want to file for one spouse, because we also know that it has implications on the other spouse while you're both living. And should you be the one to pass first, it would also have implications on what your surviving spouse may end up getting later on down the line. Now, I also want to spend an extra second talking about the need for income or whether or not you plan to work. Even though we know that Social Security gives you an 8% increase in your benefit for every year you wait beyond your full retirement age, we do not want to dwindle down your investment accounts. Because even though we're getting more income from Social Security down the line, if you dwindle down your investment accounts, and God forbid something should happen, like a health event or you have a major expenditure, you can't come to Social Security and ask for an advance. You can't say, hey, I need a little bit extra money this month. Would you mind sending me a larger check? And then in future months, you can reduce those payments. So having liquidity in retirement is extremely crucial for retirees. So we also want to juggle that balance as well in terms of what's appropriate. Now, let's talk about strategies to help maximize your Social Security benefit. One is to improve your earnings record. We discussed a little bit earlier how Social Security is calculated. They calculate your benefit by the highest 35 years of your earnings. So if you have not worked 35 years, they are going to put zeros into their calculation for some of those years. So if instead you decide to work an extra 1, 2, possibly 3 years, so we could substitute zeros with much higher earnings, that would have a substantial improvement on your benefit. Or even if you plan to work maybe not your full hours, but part-time or something along those lines. Secondly, apply for Social Security at the optimal time. I'm about to show you here in a few slides an example that we ran for a fictitious couple, and we'll see that the difference between the least optimal and the most optimal strategy based on our assumptions is a couple $100,000 over the lifespan of this couple's retirement. So this is an extremely important decision, and you want to make sure that you're maximizing it to the best of your abilities. Third is the retirement earnings test. If you are below your full retirement age and you filed for Social Security benefits, Social Security will also be asking you how much income you made from employment. And if you made over a particular amount, they will start to reduce the benefit that they pay you. This is called the retirement earnings test. So if you are below your full retirement age and you earn over $21,240, your Social Security benefit will start to be reduced. Now the amount changes and goes up slightly higher for the year you reach your full retirement age. That retirement earnings exemption amount increases to $56,250. So there's a little bit more leeway there. Now, after your full retirement age, you are able to receive benefits and make as much money as you want from employment, and there is absolutely no reduction in your Social Security benefit. So if you are still working and earning that $21,240, in all likelihood, it's going to make sense to not file for Social Security benefits until you have officially stopped work. Now, lastly, one strategy you can do to maximize is to reduce your taxes so you can collect more Social Security and pay less in Medicare premiums by avoiding what's called an IRMA, or income-related monthly adjustment amount. So let's break down the three components of this sentence. One, we want to reduce taxes just to pay less in general. If we reduce the amount of income that we're reporting, and more particularly the provisional income amount, that means less of our Social Security benefit may be taxed, meaning more of it ends up in our pocket. Now, lastly, and some of you may be surprised to learn this, the amount that you pay monthly for your Medicare Part B and Medicare Part D premiums depends on what you reported as income for your taxes. Medicare does what's called a 2-year look back. So for those paying Medicare premiums in 2023, the IRS looks at the income that you reported in 2021. And if your income has exceeded certain thresholds, you will pay more monthly for Medicare Part B and Medicare Part D. So the better that we can use tax reduction strategies and become more efficient there, We can pay less in taxes, ideally pay less or have less of your Social Security be taxed and not be hit with these income-related monthly adjustment amounts from Medicare. All of what we've talked about is very complicated today, which is why we don't leave anything to guesswork. We have very sophisticated software where we can show you a very in-depth, thorough analysis of different claiming strategies with all beautiful charts and graphs to make sure that you fully understand what the implications of your choices may be. And this is an example here of what one page of the report looks like. And these are 4 different scenarios. Again, this is a fictitious couple showing you when you might claim and showing you what the end result might be. So to back up a comment I said just a few moments earlier, let's look at scenario 1. And at the bottom here, it says lifetime nominal benefit. Now, this is, of course, based on assumptions, but this is saying over the course of this couple's entire retirement time period, they might collect a little over 1.6 million. Where if instead they optimized and used the most efficient strategy, their lifetime nominal benefit might be over 2.2 million. That is a difference of about $600,000, again, for this particular couple. And when we run these all the time, we're finding that the differences between the least and the most efficient strategy are normally in the hundreds of thousands of dollars over an expected lifetime. So this is an extremely important decision that we do not want to leave to guesswork. So will Social Security be enough to live on? For most people, probably not. Social Security, for most, represents an extremely important part of the income equation, but it is not necessarily all of the income that they will need. But given that this is a bedrock of your retirement income strategy, we want to make sure that we're maximizing it to the best of our abilities, but we don't want to be relying fully on Social Security to help support you in retirement. Also for the reasons mentioned earlier, that reforms will have to be made by 2034, and it's anybody's guess at this point as to what that's going to look like. Now, for those, again, receiving benefits, you're probably not going to see a reduction, but for those that are close to retirement or even younger workers, we're definitely going to need to plan for the reality that your benefits are going to be impacted in some way. When we're considering Social Security, we also are looking at other sources of income, be that pensions, IRAs, 401ks, RMDs, or required minimum distributions, your investment portfolio, so your non-retirement accounts, as well as any potential work. All of this is going to play as well into the other factors we mentioned earlier in regards to life expectancy and longevity. Now let me turn it back over to Jordan to bring it home.
Okay, so you have questions, we can help. Obviously, we just scratched the surface here today. There's so much more. And what's interesting is there's hundreds of different possible claiming strategies that are available out there. Question number 1, when should you apply for Social Security? What if you want to keep working? What if you've already applied and want to make any changes? How much is your benefit going to be? How do you coordinate spousal benefits if you're currently have a spouse or you're widowed or perhaps divorced? What's the best long-term strategy for your particular situation? And what do you do next? So as Sam had mentioned, we are providing to anybody interested in this free Social Security analysis. There is absolutely no cost or obligation. It's something that we do as a way of adding value and helping you. The best way to go about that is if you go online to Social Security to get your Social Security benefit statement. You would log on to ssa.gov, get the report, and then email it to us at info@dechtmanwealth.com. We would then be happy to run the analysis, to meet with you, to talk with you, to go over all the possible scenarios so that you can get the most out of your Social Security. Social Security is so important. And again, we're here to help you. We're a resource. You're not going to get all the details and particulars by dealing with Social Security itself, or as Sam had mentioned, asking a friend, neighbor, or relative. We want to get to the heart of it, the specifics. We want to help you protect your retirement and maximize your Social Security income. So if you do have a question, we welcome and encourage any questions that you might have. So at the bottom of the screen is a Q&A box. The icon's located at the bottom of the screen. If you type in a question, we're going to do our very best to answer those. We're just going to wait here a moment. Again, this presentation is recorded. We will be sending this out to you in about a week's time. And okay, it looks like we have a question that just came in. First question is, when do you apply for benefits? Well, there's a couple of ways to answer that, but depending on when you decide to start your benefits, you can apply 3 months prior. And that being said, there's different approaches depending on the tax year, depending on your income, and other factors. So we want to make sure that, again, you're maximizing your benefit. All righty. Any other questions that someone might have?
I'm seeing one right here. The question is, if I started my benefit, can I stop it or start it later? And so the answer to that question is yes. If you have started your benefit, you do have the ability to stop it and restart it. Now, there's a lot of contingencies to that in terms of what the implications might look like. It will depend on when you initially started receiving that benefit and how long it's been since you've been receiving it for when you want to stop. And so for that person that had asked, please reach back out to us so we can help you fully understand what the situation might look like regarding that.
We have another question. How does military retirement and disability affect Social Security benefits? Well, your military pension does not affect your Social Security benefits. You'll get your full Social Security benefit based on your earnings. If there is a survivor benefit that may be affected by the benefits payable under the Department of Defense Survivors Benefit Plan. How it's coordinated between military and then disability, there are some nuances there. We can talk offline specifically. Please give us a call, reach out to either myself or Sam, and we would be happy to go into more detail. All righty. Well, we want to thank all of you for attending. Really appreciate your joining us today. Please know that we're a phone call away. You have lots of resources here. If you'd like to email us with any questions and your Social Security benefit statement, please email that to info@dechtmanwealth.com. Again, thank you so much for joining us. Have a wonderful rest of your day. Bye-bye.
Thank you.